Hi everybody, it's AJ speaking. This video is a deep dive into Tesla's outlook. I record this video on October 29th, and the numbers I will be presenting are based on all of Tesla's latest SEC filings, shareholder deck, and various other disclosures, and also reflects management's latest guidance. This outlook also reflects what we can learn from various other data sources, such as, for example, surge interest in the Chinese auto market. As always, I will first share this video with my subscribers on X, and after a meaningful time delay, I will publish this more broadly. So let's get into it, but first of all, let's just see where we are. Stock currently trades at $465 in pre-market trading. The last closing price was $460. This is just under the price TSLA moved to upon release of third quarter deliveries and deployments in pre-market trading. That same day, stock then dropped. That's just a little side note. And last note before we get into, I don't write scripts. I don't read anything out to you. That's why me talking will not sound as polished as you will find it in many other videos on X. I will go fairly quickly through some high-level numbers to get rather quickly to the valuation section, which probably most people will be most interested in. And then we talk about some of the detailed assumptions after the valuation section. And that will be mostly for investors who want to understand the next level behind the numbers. So here on this first slide, you can see total revenue development, actuals, and forecast. And before we discuss the numbers, just real quick how these slides are set up. Here on the right-hand side, you see always the most pertinent financial statement relative to the metric that is being discussed on a slide. And where applicable, that metric is then highlighted where it's found on the income statement. These statements have been aligned mostly how Tesla reports them, except where adjustments were needed. For example, to accommodate future business lines, I had to expand Tesla's income statement. For example, I had to add here a robotics line item and also the owner ride-hailing and Tesla ride-hailing line item, in addition to the semi line item. Additionally, I also broke out the FSD subscription line item, which is already flowing through Tesla's income statement, but is not specifically broken out. Another universal note I would like to make before we get into the numbers. All numbers that you see in this presentation feed off one unified model. This ensures consistency. So if you were to copy all the numbers I present to you and you replicated the financial mechanics, you would have a working model that would produce the exact same outcomes. So now let's look at the numbers. So third quarter, and I will not discuss in great depth the third quarter because that's now history. I will only discuss it insofar it's relevant for the outlook. For a detailed analysis of the third quarter, I recommend to watch my third quarter financial review. That's a separate dedicated video. So the third quarter came in at 28.1 billion total revenue. That was an all-time high. I expect a sequential decrease. So sequential means quarter over quarter. So fourth quarter I expect it to come down to 27.2 billion. And the primary driver will be a reduction in vehicle sales volume. I then expect a further decline in revenue for the first quarter of 2026. And that decline is also driven by yet another reduction in sales volume. We will discuss later in detail why that is. Then second quarter of 2026, I expect the first recovery. So Q1 will be the local bottom. And then I expect that the third quarter of next year will be a new all-time high. And that means overall I expect for next year 114 billion in total revenue. That would be an 18% year-over-year increase. But where things get really interesting is 2027 and 2028, where I expect year-over-year growth rates of 36 and 28% respectively. So this second slide shows you the estimated breakdown of the key revenue contributors. As you can see, auto is expected to remain a significant revenue driver. Next, we look at gross profit. If you look over to the right, you can see how gross profit is calculated. You take your revenue and you take off, or you deduct your cost of revenue, and whatever is left is gross profit. Tesla's third quarter gross profit, as you can see, at 5.1 billion was a long-term high, despite a $400 million burden related to tariffs. This already shows you that the third quarter was substantially stronger than what the headline numbers suggested. And this is also why the stock quickly performed positively after announcing the numbers. I expect a reduction in gross profit for the same reasons I mentioned before. So volume in the auto business decreasing and other business segments cannot fully offset that decrease. Next, we look at the composition of gross profit. Since Tesla has business segments currently and going forward with vastly different gross profit margin, i.e. $1 of revenue in segment A versus segment B can have a vastly different profit impact. A gross profit view is much superior than just looking at revenues. So the outlook as presented shows you that the auto business will remain a major gross profit contributor, but you can also see that over time there are other segments that start to contribute quite meaningfully. There may be some trends that appear counterintuitive, for example, the energy generation and storage segment, but we'll discuss later why that is in detail. So this next slide is pretty much the same slide, just organized slightly differently. You can see the different years and the segments ranked by gross profit contribution. You can see that auto excluding leasing will stay the number one segment throughout 2028. Energy and storage stays number two. Then energy and storage stays number two throughout 2027 and then is replaced by Tesla's ride-hailing network. As I said earlier, I'll explain later why that energy and storage development is probably counterintuitive to a lot of Tesla bulls. Next, you see that regulatory credits used to be a very important part of the business. I estimate it to be still number two in terms of gross profit contribution in 2025. Then drops next year to number 4, drops to 6 in 2027, and becomes quite irrelevant in 2028. In 2026, I expect this service and other segment to replace regulatory credits as the third most important gross profit contributor. The other segments we'll be discussing in the respective section. Now we jump quite a bit in the income statement, so we discussed revenue, gross profit, selected segments, and now we skip over research and development expenses, selling general and administrative expenses, and restructuring and other, because the total of these three items, that is total operating expenses. And you see them in front of you, and you can see there in the historical numbers there have been certain peaks, and each of them was related to very large restructuring charges. So for example, in Q2 2024, Tesla booked 622 million in restructuring charges. That was an all-time high by a significant margin. And then Tesla booked in the most recent quarter, third quarter, another 238 million restructuring charges. On top of that, Tesla disclosed, but did not give us the exact number, that there were legal expenses. And in accounting practice, the fact that Tesla mentioned legal expenses as an SG&A driver means those legal expenses exceeded a certain materiality threshold. Otherwise, Tesla would not have mentioned those legal expenses in the notes. So we can basically, so keep in mind there were these two significant outliers, so restructuring charges and large legal expenses. There were also some other amounts in relation to Tesla organizing the November shareholder meeting, and that amount was approximately 25 million. So the bottom line is there were various one-off effects, and that explains why my fourth quarter OPEX forecast is substantially lower than what was reported in the third quarter. I would also like to point out, since I'm expecting reduced volume in the fourth quarter, and there is some SG&A spend that is correlated with vehicle sales volume, that also provides a relief for operating expenses or a reduction. The reason why I still forecast an increase in the first quarter, even though I expect volume to be even lower, we'll be discussing when we get to the SG&A and R&D section. So the net result of gross profit less operating expenses is operating profit. That is a key metric in every business, since it shows you how much the business generated in, let's call it core profits. The only exception to that statement includes businesses that have substantial JV income that is accounted in the as income from equity and is not reported in operating income but in other, or I should say non-operating income. But that does not apply to Tesla. So let's look at the numbers. Operating profit came in at 1.6 billion in the third quarter. There was quite a substantial increase from the second quarter, despite these one-off items I already mentioned. Because you can see this here on the right side, these restructuring charges, they were before, or I should say above, the operating profit line. So it's reflected in operating profit is deducted. And also these large legal expenses for which we do not have the numbers, they are reflected in this line at SG&A. In addition, I'd like to repeat that this line item, cost of revenue, did include $400 million in tariff-related spend. However, that line item is not a one-off. This is, at least until there are changes to tariffs, an ongoing headwind up until Tesla found alternatives. So, and Tesla obviously has a significant motive to quickly sort the situation. Therefore, I assume that going forward, this tariff headwind will slowly reduce. On top of that, I expect substantially fewer US sold vehicles in the fourth quarter, and that has the counterintuitive benefit that this tariff-related headwind is less, because obviously these tariffs apply only to US vehicles. However, these 400 million, they apply 50-50 to the auto segment, and the other half applies to the energy segment. So the energy segment, it's kind of the opposite situation. In the energy segment, I expect continuing significant growth. So there could be more tariff-related headwinds. However, Tesla did tell us that they've been using the Shanghai Megapack factory to service or to satisfy non-US demand, and that would help to mitigate those effects. So overall, I do not expect incremental negative headwinds from tariffs in the fourth quarter. So now let's look at the fourth quarter of this year. So I expect between 1.4 and 1.5 billion. Again, the key driver is reduced volume in the auto segment. However, I also expect continuing strong growth in R&D spend. That is also in line with management commentary. However, the big benefit, which also helps significantly to offset lower US vehicle sales, is that it's unlikely we have similarly large restructuring charges in the fourth quarter. So the lack of that one-time negative in the third that what happened in the third quarter provides a sequential boost to earnings effectively. Or the way you can think about it, if that negative headwind in Q3 would not have existed, that number would be much higher, and you would see a much more clearly the sequential decrease. Then in the first quarter, I expect right now, or it's the wrong way to say it, the modeling implies 1 billion of operating profit. And again, that's caused by a significant reduction in auto sales, and we'll be discussing the details later, while I expect ongoing high R&D spend. Then second quarter of 2026, I expect even slightly less operating profit sequentially, despite a recovery in vehicle sales, and the primary reason is still growing R&D spend. But I will discuss my rationale for this high R&D spend in the R&D section later in this presentation. Next, we talk about adjusted shareholders' net income. That is a key metric because that's the metric on which non-GAAP or adjusted earnings per shares are based on. And you can see down here how it's calculated from operating profit, the number we just looked at. You have to account for non-operating items, which comprise interest income, interest expenses, and other expenses or income. That is a material item quite often in Tesla's case. Then you get to profit before tax. You have to account for tax provision. Here also, that's an item that deserves scrutiny because this can also significantly affect the assessment of a quarterly performance, which we'll be discussing later. And this actually applied to the third quarter. Then when you get to total net income, so after you deduct the provision for income taxes, then you have to take out a small amount of non-controlling interest in Tesla's case. Then you arrive at GAAP shareholders' net income. But then for valuation purposes, to have a consistent metric, you have to make a few adjustments. And the most important adjustment is that you have to add back the spend on SBC, that share-based compensation. And then there are certain other SBC tax-related adjustments, and also, most importantly, there is the removal of the impact of Bitcoin. Since Bitcoin is a non-cash effect, provided Bitcoin isn't sold. The net result then gives you the adjusted shareholders' net income, so the metric you're looking at right now. So that number came in at 1.77 billion in the third quarter, and that was the strongest shareholder net income since the fourth quarter of last year. And now comes something that's probably quite counterintuitive if you followed along thus far. I actually expect a modest increase in shareholders' net income in the fourth quarter. And we'll be looking in a second at a breakdown that will make this quite easy to follow along. But before we do so, let's turn this metric into a earnings per share number. And all we have to do is we have to apply the diluted number of shares outstanding. So we take these numbers and divide them by the fully diluted number of shares outstanding. Once you did that, you get to these numbers. So these numbers are now EPS, so earnings per share, diluted and non-GAAP basis. So non-GAAP meaning making these adjustments down here that we just discussed. The reason why you have to do them, because of the share-based compensation, is to achieve consistency with the share price, because the share price is reflecting full dilution. So Tesla reported 50 cents in EPS, in this EPS. There are different EPSs, but they're mostly irrelevant. And that was below consensus estimates, but key drivers included, and we'll discuss this in a moment, the restructuring charges, the litigation expenses in SG&A, very high effective tax rate. So if you adjust it for items which are almost certain that analysts did not account for, then you actually could see that Tesla actually beat consensus estimate. And I think this is why after a little delay, we saw a quite meaningful positive share price reaction. And that's why I told my subscribers basically within the first couple of minutes after numbers dropped, that was a good set of numbers and nothing to be worried about. But of course, if you read mainstream media, all you would read about is, oh, Tesla missed estimates, which again, I believe is complete bullshit, because you have to look at this on a normalized basis. And I will never understand why the financial rookies will never understand this. So I expect this increase, as I said earlier, currently my EPS estimate is at 53 cents. I'm saying currently, because from the second half of the quarter, this is the earliest point each quarter where we get meaningful or pertinent delivery data. I will start to check whether sales development lines up with my sales development expectation. And as each quarter, the closer we get to quarter end, I will make calibrations to my sales outlook to reflect the data. And this can lead to earnings upward or downward revisions. On top, these updates reflect whether we see in significant markets, significant pricing adjustments, or sales campaigns, for example, highly subsidized leasing rates. My current forecasting does account for increased incentives in the fourth quarter. And the underlying rationale is to counter certain one-off effects and take advantage of others. But I will explain this later when we discuss about geographic deliveries. So then when we move on to the first quarter of 2026, I expect a further decrease. This is again mostly driven by a volume reduction in automotive and with insufficient offset from other segments. Basically no material improvement in the second quarter. Again, this is driven by my expectation of increased R&D spend, but more about that later. And then we see a meaningful recovery from the second half of next year. And this is very consistent with what I said already in the second half of last year. And the primary driver for the improvement in the second half is that various new products start to kick in. So now let's talk about why specifically my forecast implies there might actually be an earnings increase in the fourth quarter, even though Wall Street is very pessimistic. Wall Street currently, at time of recording, expects 44 cents. You can see here, I expect, so this is 3 decimals, so rounded, that would be 53 cents. And you can see the key drivers here. So what you see in front of you is a bridge. So I bridge from the Q3 EPS, which was 50 cents, to the fourth quarter. So what you see is not the amounts here, these steps here. This is the change in each metric. So for example, when you look at the add back of SBC, share-based compensation, the share-based compensation add back has not a total impact of 0.7 cents. The change in the add back has a positive effect of 0.7 cents. That's the way to read this chart. So if we now go, or let's not go through all the items because it would take too long, just focus on the big needle movers. And the biggest one, let's start with the biggest headwind. That is here auto gross profit. So because I expect meaningfully less volume plus much weaker margin, I expect a significant loss in gross profit. And so this is this headwind here. That would have, expressed in EPS, this would have almost a 19-cent headwind, or that creates almost 19 cents headwind. But then we have some upsides. And one big upside is SG&A spend. SG&A spend, I expect normalizes, and we will discuss this later when we talk specifically about total SG&A development. And as I said earlier, this has to do with volume, but also that this large litigation charge Tesla booked is non-recurring. So that gives us almost 6 cents in uplift. Then, of course, the restructuring charge is going away, but prudently, I'm assuming it's not entirely going away. I still account for 10% to be booked in this quarter. And the reason why I'm doing that is that while typically these restructuring charges are all taken up front, there can be some cases where this is a bit drawn out and where there is some residual restructuring charges booked in a subsequent quarter. This pattern was observable last year after the all-time high Q2 2024 restructuring that saw in the subsequent quarter, Q3 2024, still some, but much less restructuring charges. So that gives us another roughly 6 cents in offset. And then I expect continuing strong growth in the energy storage segment. And that provides us with a little over 4 cents of offset. Another one that I think people, at first at least, didn't have on the radar immediately was that Tesla had a very high tax rate. And that tax rate reflected a permanently high effective tax rate, but also some one-time effects. And that's something we're going to discuss when we dive into Tesla's current tax situation later. And I estimate that combined will add just under 2 cents in EPS uplift. And then there are a bunch of smaller items that in sum also provide a bit of an EPS uplift. And then when you add everything together, you realize, EPS is actually not going down. It might actually go up. And just for clarity, this bridge, because this is on adjusted or non-GAAP EPS, is for this metric, however Bitcoin might move in the quarter, is completely irrelevant because Bitcoin is being adjusted out. The one potentially also one of negative I have not yet mentioned at all that occurred in Q3 was 108 million in FX headwinds. That meant that cash balances Tesla holds in foreign jurisdictions in a currency denominated other than US dollar depreciated against the US dollar, which meant when they were for consolidation converted into US dollar, they turned into fewer US dollar. And that change was reflected. It's a non-cash item, but weighed on earnings, and it's also not an item that is being adjusted for. They created a headwind of 108 million. And the important thing to point out is if these currencies stay constant relative to the US dollar from one valuation date, which is the last day of the quarter or of the third quarter and the last day of Q4, then there is no change. And should they appreciate and Tesla not move around cash balances, then it could be a gain. So that's also something I will be updating later in the quarter when I share my periodic updates to this analysis. The currency you want to look for predominantly that account for most of the FX movement is, of course, the Chinese yuan, the euro, the Norwegian krona, and the British pound. All other currencies are not needle movers. So next I jump quickly back to the EPSs we looked at earlier. Because we are soon entering a valuation, we need to change these EPSs to a next 12 months metric, because all multiples work on an annual number, and these are quarterly numbers. So basically, what we have to do is we just have to add up from a certain point in time the next 4 unreported quarters. We can use this chart, makes it easier. So here again, you see the EPSs, so the 50 cents that were reported, the 53 cents I'm forecasting for the fourth quarter. And then up here, after a reporting date, so for example, Tesla reports in April 2026, first quarter results. After the reporting day in April, the next 12 months EPS comprises the second quarter, third, fourth, and first quarter of 2027. So after earnings were released in Q1 2026, so in late April, the next 12 months earnings number jumps to $2.16. I'm just explaining this so you understand how you get from A to B basically. So my long-term follower, they know exactly how this works, and this is actually very standard and is applied across Wall Street. But you see already the problem. This gives us these quarterly jumps. So you jumps from 199 to 216, 251, etc. For what we want to accomplish later, a share price corridor protection, a continuous number is much preferred. So what we can do is we simply linearly extrapolate between two quarters. That does not affect at all the forecasted EPSs. This just gives us a number between reporting dates. That is a better approximation of the sliding nature, let's call it, of future earnings. So for example, on this slide again, so the after the April reporting date, the next 12 months earnings number is 216. If we now jump, so keep that number in mind. So on this next slide, you see the 216 right here. Down here, you have the time scale. So this marks that point. So you can see the numbers are not changed. We are just creating this extrapolation. So and the end result gives us this dashed line, this what I will refer to as earnings curve. And that is the first key input to generate a valuation corridor. The second input that we need a valuation multiple. But before we move on, I would like to point out one thing. Although this earnings curve looks like almost a random curve, to generate that curve, you basically have to build a massive model to reflect all of that, what you see here on the right-hand side. I just wanted to point this out to make this very clear. This is not a random curve. This is derived from literally thousands of lines of modeling. So next, we need the multiple. So and this is what you see here in front of you. And so let me first explain the lines. So first of all, you have these red lines and green lines and this dark blue line. So let's start with the dark blue line. So the dark blue line shows you from today's perspective the median implied multiple over the last 12 months. And the multiple we are looking for is the implied next 12 months, or also called forward earnings multiple. So you take forward earnings and you take the price and you divide, so you take the share price on a given day and you divide it by the next 12 months worth of earnings per share, and that gives you the multiple. And then the green and red line, this is just the 1 times and 1.5 times standard deviation around that multiple. And that's just to highlight a frequently occurring multiple range and a less frequently occurring multiple range, because that is helpful to show you what is a true outlier. And you can see that the Trump rally that kicked off with Donald Trump's victory in November and lasted up until the Fed meeting in December of 2024 created a massive valuation outlier. So next I'd like to discuss the different colors here for the multiples line. So we discussed these horizontal lines, but these other lines, so this gray line here, that is actually the true forward P of Tesla. So I call it true because it's based on the earnings that from a given closing prices perspective, what was the real earnings that Tesla delivered in the following 4 quarters. That's why it's the true PE and not a consensus estimate derived PE. Because the problem is with consensus estimate derived PEs, there is estimation error and there is investors' view of the consensus, whether it's overly optimistic or overly bearish. And to get away from all this noise, it's much better to go back and calculate the true PE. The only downside is that you can only do it up to a point where you have visibility of the next 4 unreported quarters. That means to calculate the latest multiple, you can only do it with almost a year or a year time delay. So, and you see this here, so this gray line stops in October, and this is, and then we move to the next line, and the next line is the blended multiple. And the blended multiple is a multiple that uses whatever reported earnings were available from a forward 12 months perspective, but complements with estimates where a full set of 4 quarters is not available on reported basis. So if there's only, let's say, 3 quarters of reported available, there's 1 quarter supplemented by an estimate. And then we move into a completely implied next 12 months PE once we completely run out of future actually reported quarters. So the last tip that you see here on this line is completely based on estimates. So this could be wrong. So for example, if Tesla delivered in the fourth quarter much lower earnings than I expect, and also in the first quarter of next year, second quarter of next year, and third quarter of next year, that point would be much higher right now. But also conversely, if my estimate is too bearish and Tesla delivers higher earnings, then that point would be much lower. And another point before we move on and look at what this then implies in terms of share price projection is we should take note of where Tesla traded in terms of, before the change in administration. So Tesla in the trailing 12 months immediately prior to Trump winning, Tesla traded at 99 times forward earnings. So the transition to the current administration clearly huge upside for Tesla, but not all of it is politically triggered, let's say. But also during this period we saw a significant increase in the overall valuation level in the market. So that's something to keep in mind. So and before we move on, let's look at the latest numbers, and you have it here up in the headline. So the current latest implied multiple based on my earnings outlook, Tesla trades at 239 times forward earnings. That is extremely high, and one could call this dot-com bubble stock era. But here is where let's say classical valuation analysis and sentiment analysis meet. I believe that in outlier stocks, you will always be behind and will always miss the opportunity if you stay too attached to classical valuation methods. And I'm saying this as a valuation expert in these methods. So as a hammer, for me, everything should be a nail, i.e. someone like me would normally say, okay, this is completely overvalued. But to be successful in the markets, I also had to evolve from my classical training. And I realized what I think in terms of academia, how much something should be valued, nobody cares about. And ultimately, the only thing that matters is the market. And Tesla has a lot of course, outlier unique things going for them. Most importantly, they have Elon. And Elon just attracts a huge premium. And I think not accounting for this huge premium or discounting it is a huge mistake. And for that reason, I think a superior approach to assessing Tesla's valuation, while not completely discarding classical valuation frameworks, is that instead of looking at the absolute multiple, which is 239 right now, the superior approach is to look at the relative valuation level. And this is something I've maintained for a long, long time. I always argue, and I argued with my colleagues and superiors about this point in the past. Each stock has its valuation level, and a comparison with peers, typical peer benchmarking, has only limited relevance. There's even in the same industry, certain stocks that always or over long periods consistently attract a higher premium than basically company on paper that is the same. I give you a completely sorry, I want to give you an example that is completely unrelated. So, for example, in the insurance space, there are large insurance companies, Allianz, a German insurance group, and Zurich, which is a Swiss insurance group. Both are large global insurance companies. Zurich always, or for a long time, always traded at a premium to Allianz. And the reason was, even though they had a significant overlap in terms of product lines, they're both P&C and life insurance providers. Zurich had this large fee-based business in the United States. And that's why Zurich always attracted a high multiple in Allianz. And if we apply this to Tesla, I think using auto comps is completely pointless. And because Tesla has Elon, and Elon is completely unique, there is no comp you can realistically use. And also Tesla has such a large fan base, and let's call it fan investor base, that can also move tens of billions of purchasing power globally. I think one is much better guided by looking at the trading level. So now let's do that. So what we can see is that over the last 12 months, after the Trump won, of course, there's been a huge increase in the multiple. But what's quite remarkable, even though this was a period of, let's call it extreme exuberance, which peaked in December 2024, but then also a period of extreme depression. People listening to this will all remember the period where Teslas had been vandalized. Sales came in quite below 400,000 units, significant sequential year-over-year decrease, and a bunch of other negative things I don't want to repeat right now. But the bottom line is you saw this massive pullback. Again, what you're looking at is not the share price, it's a multiple, but it's closely related. So you had these huge swings, but despite this period of quite material turbulence, and also remember the market pullback in April, the global trade wars, elimination of credits and a bunch of other stuff. Despite all these turbulences, Tesla maintained, based on median basis, a 181 times forward multiple. So that is a true strength in the stock, and I think using these observable levels specific to the stock will yield 10 times better outcomes than using purely classical valuation method. So that's why I marry basically classical valuation with sentiment analysis, and that really generated huge alpha. But before we move on and look at what this actually means in terms of share price corridor, I need to remind everyone about one important thing. So this is a chart generated by JP Morgan Asset Management. It shows the forward PE of the S&P 500 over the last, 30 years. And it's updated as of end of September, and the S&P 500 was at traded at 22.8 times. This is very high, as you can see, by historical standards, because every time we reach this level, not too long thereafter, there was like a major calamity in the market. And this is basically the main topic underlying everything you see in the market that is in the back of investors' minds. But before we move on, and I'm sorry if you listened to this before, I just want to repeat a few very important things to put this into perspective. Number one, here the great financial crisis, which pulled, of course, down the average multiple that you see here, was an unprecedented financial catastrophe. I lived through this. I was basically in the epicenter of this crisis because I was an advisor to FIGs, so financial institutions groups. My clients were customers, asset managers, insurance companies, and a lot of them went bust left and right. And I was later involved in a bunch of fire sales and other unpleasant things. And that, in terms of financial markets effect, it was by far the biggest event since the Great Depression. I also can say, because I'm an expert in that field when it comes to regulation, markets have vastly matured since that happened. And much more sophisticated risk management systems have been implemented in banks and insurance companies. So, and for example, not long ago, the collapse of Silicon Valley Bank and its basically nothing burger impact on the markets shows how much more robust the system has become. There are various other mitigating factors, so I believe a repeat of the great financial crisis is quite unlikely right now. Then let's talk about the dot-com bubble, because that's often cited by poorly informed people on X and other places. When they talk about NVIDIA has absolutely nothing to do with the dot-com bubble. And during the dot-com bubble, a lot of companies, they traded at forward earnings of several hundred times by my estimate. And my earnings estimates have been the most accurate I have seen, actually. I'm not joking. NVIDIA trades at significantly below 40 times forward earnings. So a completely different situation. And then we come to the third large, let's call it market catastrophe, which was COVID. COVID saw unprecedented global supply shutdowns and unprecedented money printing. And then that led to a almost unprecedented spike in inflation. So that was also a very outlier situation. So, and right now, of course, we could have another pandemic, but I think the experience of the prior pandemic made us more robust in the face of a future pandemic. Of course, it depends on what type of pathogen we would see. But long story short, I think a lot of these comparisons with prior recessions and pullbacks, etc., they miss some very important differences. On top of all of that, I think compared to prior fundamental technological revolutions, I think AI is a different kind. But in this video, we're not going to dive into AI because that would be in itself a very long discussion. So now when you add everything together, so the earnings curve we generated from thousands of lines of modeling all of Tesla's financials, taking in management guidance, future business lines for which we have visibility, robotaxi, semi, etc. Look at the 12 months implied median based on forward earnings and put everything together. That's the outcome. So the outcome is that this corridor as shown with these red-green lines, and then with in the center this gray shading, then this gray curve, that's the share price now. So Tesla's share price moved around, call it 450 to between 450, 150 roughly. And you will see right away that, oh, hang on a second. That corridor you're projecting is completely off if we go back further in the past. And how could this possibly be correct going forward if it's so wrong in the past? I have to point out this is by design, because the corridor that you see is not based on a rolling median multiple or something. No, it's on purpose designed to just look at the last 12 months implied forward multiple. And the reason for that is I want to have recency bias. I don't want to care about 2021, 2022 in my valuation that I do in end of 2025. I care about a more recent period, although you want to be cognizant of the fact that you don't want to be too short-termistic, because you could in theory also just take the latest multiple, which would be 239 times. But we all know that things not always go up in a straight line. There's volatility. So you have to strike a balance between a reasonably long multiple to capture, let's call it a more normalized trading level, But you don't want to be too long to capture not too old or stale trading levels. And when we looked earlier at the multiple, you saw that prior to Trump winning, Tesla was at 99. But after Trump winning, Tesla maintained almost, or I should say most of the time, almost 2 times higher multiple at around 181. So then the last question you might have, okay, so why then you're showing this this way? If it's only based on the last 12 months, why you're showing these prior periods? The point is to reflect how the trading level has changed. By here the corridor showing that it's substantially above where the share price was, shows you graphically how significantly the valuation level has changed. The key observation here is if you applied today's valuation level, and by valuation level I mean the multiple, if you applied it, and the multiple is a reflection of the sentiment of the market, and remember, the market is always right. If you applied this market sentiment to, let's say, December 2021, the stock would have been at $700. So with the earnings level, and again this is forward earnings from December 2021's perspective, the stock would have been, if the sentiment would have been similarly strong, would have been around 700 or potentially even touching 800. That is here a key insight. So even though long-term Tesla investors and memories are fleeting, might think, oh, Tesla, much better brand image and blah, blah, blah. You often hear these stories, but quantitatively, and this is reflected in multiple, the sentiment in Tesla has never been stronger. So the key insight here is not to say, oh, yeah, that means Tesla is overvalued. No, the key insight is Tesla has had a very strong sentiment for a long time, and then managed to even boost it more, substantially double it since Trump won. And the key takeaway is that even at almost 100 times forward earnings, which was already, remember, when it happened, considered as extremely high, the stock went on and still moved up to nearly double. That is the key insight here. So no matter what you think about valuation level, etc., again, the market is always right. And the fact that the stock has defended for so long such a high level means that you should really drop your archaic view of valuation. Because ultimately, what something is worth does not matter what you or I think. The only thing that matters is whether there's a third party that is willing to pay a certain price for it. And at least at the moment, there are a lot of people that are willing or happy to pay a very large price to get a piece of Tesla, which means also to get a piece of Elon. So next we zoom in a little bit and we talk about price targets. So from the current share price, which is around $460 per share, based on earnings and current sentiment reflected in the current last 12 months medium forward multiple, the earnings curve I'm projecting implies a share price in 12 months of between $520 and $570. That, and I get this question quite often, does not mean it cannot touch 600, because this is like this price range is based on a median multiple, but as you can see in this green and red lines, there can also be quite often quite substantial outliers. So even if my earnings forecast is 100% accurate and the multiple is 100% accurate, given the volatility around the median, the stock can easily touch 650, and my forecast would still be accurate. But if I gave you a 12 months range showing the full range of between the upper and lower red line, that would not be that helpful. So when you look at this price corridor, the way at least I look at it, okay, the gray line, okay, this is the most probable. However, depending on the circumstances in the moment or in the week or quarter, for example, if Elon bought, let's say, so in 12, so by the way, these vertical lines, these colored lines show you the price target. So this blue line is current, and then this first line here is the 12 months price target, and then the 24 months price target. And for example, if in October next year, just prior Elon buys more Tesla stock, then of course we would see a massive spike again, and we could easily touch 650, potentially 700, whatever. So the point of this corridor is not to say, okay, that's going to be the exact price. It's more to give you conceptually a framework that captures all information that we have at time of making the forecast, making the corridor, to give you a sense of where things could be going. You should not have the expectation it's 100% accurate, but the way to use it is to basically look at your situation, whether you want to buy more, trim, whatever, for whatever reason, and assess whether this would support your decision or would create a data point that would vote against it. Just to give an example, for example, if Tesla for whatever reason dropped to the lower green or red line, that would be a very strong buy signal. But should Tesla detach further from the top red line, you would have to think about, okay, do I want to currently add more? While you also keep in mind that when you move along this red line, let's say Tesla moved up to this horizontal line right here. It based on his analysis would be quite significant out of the normal trading range, but this would be so October. But if it maintained roughly that level, of course it will always fluctuate for all kinds of reasons, and you waited just 5 months, 6 months, it would already move back into the more common trading range. I hope I'm not over-explaining, and people to whom I explained this before, they're probably bored now, but I just want to make this very, very clear, because sometimes I got comments where I felt like this chart is not 100% understood. And maybe it's my mistake, because I might have made it too deceivingly simple or intuitive looking. So now let's zoom in a little bit more. So this is the exact same chart you just looked at, just heavily zoomed in so we can more clearly see the trading levels. So you can see right now stock is outside the range you would normally expect. But you can see as it defends this level, just let's say up until, let's say April, we are quickly entering a period. And again, it's all based on forward-looking earnings. We are approaching a period where there is massive share price upside risk. That's something to keep in mind. So the closer you get to these, what I refer to detachment points, you want to be not too stingy. You don't want to be betting on or trying to overtime the market. Because again, you should not assume this is like 100% accurate. This should be giving you a guide where there is a void of quantitative guidance. So let's talk about the key takeaways. So over the next 12 months, there is attractive upside, and that would suggest should there be a troughs or let's call it pullback, those would be good buying moments, since as you go further out 24 months, there's massive upside. So we could see, if my analysis is somewhat ballpark correct, we could see a Tesla stock hitting around end of 2027, $1,000 per share. But I must point out the one big key thing in Tesla, that is key man risk. Everything you see here in terms of valuation depends, I have to say, almost entirely on Elon, because the stock has such a high multiple that a Tesla excluding Elon, even if robotaxis kick off without any problems, Cybercab ramps without a problem, there's even Optimus production end of next year, gets a great customer feedback, everything works perfectly. The earnings generation is simply not there. And this, my might come to a surprise to some people listening to this, but even if you add everything together and great margin, energy, blah, blah, great growth, the valuation from the earnings is still too far apart. So this is the one thing every investor in Tesla has to accept, because if you price in that Elon, for whatever reason, would not be around, a Tesla, you cannot buy the stock. So what have I done? I've basically decided I ignored it and accept that risk, and accept that if something happens and I lose, and I guarantee you, if, again, I don't want to talk about it too much, but if anything happens to Elon, stock tanks basically immediately 50% plus. I have absolutely no doubt. And stock would have a one-day massive drop, and then would just keep dropping, because people would start thinking about all the horror scenarios that would ensue without Elon. Oh, key people leaving, activist investors coming here, a bunch of nonsense. So there would be a shitstorm of epic proportion. And a lot of investors would front run it, and that would be vastly amplified by short sellers who have been waiting for that opportunities for, at this point, over a decade. Okay, but let's move on from this horror scenario, which may never happen. So if everything works out okay, which right now appears to be the by far most likely scenario, then there's massive upside in Tesla still. So that concludes the main part of the presentation. Now, so in the second part, we discuss some of the, or many of the key driver underlying this financial projection. So now we dive into the details. This is just a high-level summary of revenue, gross profit, and implied gross margins. I just share this for people who like to look at things in table format. The key item that I'd like to highlight here is that from the second half of 2026, the forecast implies a substantial increase in gross profit. So after 4.3, 4.4 in the first and second quarter, it moves up by about 10% to 4.9 billion, and then reaches a new all-time high in the fourth quarter of next year. So if you want to look at these numbers in more detail, I recommend to pause the video. So here on this next slide, you will find the exact same table, but this time on a more aggregated level. So you see full years instead of quarterly basis. And here I would like to point out again the gross profit increase. So from 2026, we see a massive increase, and then a massive sequential increase in 2027, 2028. And when you look closely, what is driving this quite substantial increase? So I expect a significant increase in the auto business. Full self-driving or FSD subscription start to kick in more meaningfully. Regulatory credits create a headwind, they go down. Leasing stays pretty much flat. The semi business starts to kick in. Energy storage is surprisingly relatively flat. We will discuss later why that is. Then there's almost no material contribution from robotics yet. And we will also discuss, and we will heavily leverage Elon's comments to discuss why that is. Then the owner ride-hailing network. So this is where Tesla owners can contribute their hardware for or above, at that point, Tesla to a Tesla-managed ride-hailing network. And then we have Tesla's ride-hailing network, and that will be the big driver in 2028. Will meaningfully contribute in 2027, but 2028 is really where ride-hailing kicks in. And this is mostly driven by the ramp-up that is required. And then also we see some meaningful growth in service and other, which is probably the most predictable segment in Tesla's entire business. And then when you add everything together, even though, especially in 2027, there might not be that killer segment, but if you add all these bits and pieces, you still get to quite a substantial gross profit uplift. And just real quick in terms of margin profile. So I still expect a relatively modest gross margin throughout 2026. There will be various pluses and minuses. I expect Tesla to be very aggressive to maintain volume. There will also be various ramp-up effects. FSD subscription is a mostly software product. I assume Tesla can generate a 95% gross margin. This is derived from similar products and disclosure from our companies. The leasing margin looks very high here, but without getting into the details, leasing gets a very different kind of accounting, and the gross margin is not really a great metric. I just added it here for consistency. So an overall leasing business is not a material part for Tesla, because the vast majority of Tesla's leased vehicle sales, they're actually via third parties, so that it's not on Tesla's balance sheet. Tesla's on-balance sheet operating leasing fleet is actually very small. And that's why the percent of leasing sales that Tesla reports every quarter, together with deliveries and deployments, is a very small number. There's often confusing people. They think, very few people lease Teslas. That's not correct. Teslas are basically being leased at a very similar rate as comparable vehicles. It's just that Tesla prefers to use third parties, so banks and other financial institutions that provide the leasing. For example, in Europe, a big partner of Tesla is a large Spanish bank, Santander, but these banking partners vary depending on jurisdiction. That is a prudent form of managing the business, since it limits recourse to Tesla. So next we look at semi. So in 2026, I expect a negative gross margin. That's simply because I expect a slow ramp, and so vehicles are produced at a very low rate. They're not made by hand, but the production line needs to be tuned, etc. Employees need to get up to speed, etc. And it's not uncommon to see for a number of quarters a negative gross margin. After in brand new platform launches. This should not be confused with a refresh. Refresh is very different, because a refresh often entails only a very limited change in production or manufacturing processes. When it comes to the semi, it is a completely new type of vehicle, of course, much larger, and has other significant differences. So therefore, I'm taking a prudent assumption here that ramp might take a while to get to gross margin profitability. The other reason why gross margin profitability in the first year is unlikely, it's a brand new facility, so it has brand new staff, etc. It's made for relative large volume by trucking or semi-truck standards, but because I expect a slow ramp, there will be low volume, and therefore this large new facility imposes a very large depreciation charge per unit, and therefore the gross profitability will likely be very, very low or negative, as I forecast in 2026. Then we get to the energy business, and here you see why gross profit, if you look at energy, is not really growing much. So there's quite substantial growth in 2026. We grow from 3.9 billion to 5 billion. So that's an over 25% increase in gross profit. So it's quite substantial growth. But then gross profit goes down. So what the heck is going on? The key driver behind it is that the massive gross margin Tesla currently generates with energies, which is over 30%, actually 31.7% in the third quarter, I believe is not sustainable. I think we are right now in a moment that is comparable with the automotive era in Tesla's history, where Tesla had 30% gross margin in the automotive business. 30% gross margin is exceptionally high. This is usually reserved for relatively niche luxury car makers, but is not observable in volume makers. So what I believe is currently happening, we are right now going through a phase. Right now we're basically a Goldilocks zone. There's huge demand from hyperscalers. Depending on the geography, there's limited competition, but competition is growing quickly. And it's also something I noticed Tesla starts to increasingly point out in the earnings call, such as the last earnings call, because ultimately megapacks are commodities. I know a lot of people will disagree with me, but when I look at the details of some project in certain jurisdiction, there is clearly a price competition. And there is competition emerging in on all continents. So I expect that a scenario that is comparable to the EV space is very similar, that Tesla will still make good money with power packs, while others will likely sell their product at marginal cost. And that will drive down Tesla's exceptionally high margin for this type of product over time. However, there is a scenario where hyperscalers, huge demand, offsets that margin erosion effect from competition. That would create upside in the forecast. But keep in mind, for 2026, I still forecast a 27% gross margin. So at least near term, it appears that potential upside is more limited, because where I expect a significant margin erosion is more from 2027 and 2028. And at that point, already other product lines start to kick in a much bigger way. So at that point, the energy's business potential upside, incremental upside, is likely dwarfed by these other businesses. Hence, I believe the overall impact of the potential prudency is largely mitigated. Or put differently, another, let's say, 2 billion in gross profit on a 47 billion already forecast gross profit base doesn't make that much of a difference. So next we move on to robotics. So robotics, of course, it doesn't exist as an active business line right now. We're still in development and research. But I expect, this is based on management guidance, there's some production next year, but it will be, I think, quite limited, and it will be mostly loss-making, negative gross margin. And in principle, the higher volume Tesla is targeting, the more loss-making it will be in the beginning. Because if Tesla builds it for really large volume, it requires much larger capacity infrastructure, and that will be more costly, and that will incur higher depreciation charges, and then therefore, as long as volume is very low in the beginning, creates even higher losses. But overall, it's not a big deal, because overall it's not that big of a business at that point. So the 60% negative gross margin shouldn't shock anyone. And then from 2027, as early production kinks are being worked out, it starts to contribute positively. Again, the numbers we are talking about here are full year numbers, but they are derived from quarterly projection. So what you see are aggregates. Then we move to owner ride-hailing. This, again, software margin business. Tesla just connects supply and demand. This would be very similar to Uber, where the Uber driver supplies the vehicle minus the Uber driver, of course. Overall, I believe this will not be a massive business. I know, again, a lot of people disagree with me on this point. I think when the biggest limiter for that type of business is Cybercab. Because ask yourself, most of the time you don't need the space of Model Y or Model 3. The Cybercab with its large trunk will be entirely sufficient. Most of your rides will be by yourself or just with your partner. So 2 people, just look at statistics. Vast majority of rides is up to 2 people. So now add 2 and 2 together. What vehicle would you prefer riding in? A Model Y, provided by an owner, where you never know in which condition you get it, especially in terms of cleanliness, or you get a Tesla. And we can draw from other industries. For example, my favorite example is McDonald's. Abroad, a lot of Americans, they like to go to McDonald's if they go to Thailand or other countries. Why? Because McDonald's is standardized globally. At least the core menu is. So when you go to McDonald's abroad, you know exactly what you're getting. And that effect is very important in consumers. And I think this also applies to Cybercab. People know what they're getting. Plus, a owner-contributed vehicle is likely more expensive. As long as there is not a sufficient supply of Cybercabs. Yes, there is a model, but as soon as at least in the high-density markets, there's a sufficient Cybercab penetration, there is no real market for this type of model, I think. Or if there is one, it will be a modest part of Tesla's business. Also keep in mind what limits this kind of business is based on what Tesla told us. We have to assume that Hardware 3 vehicles will never be able to run the latest and greatest Tesla software to a level where it can be a fully autonomous vehicle without any supervision, which is required to be a robotaxi. That takes off roughly 4 million units from Tesla's current over 8 million vehicle fleet. And then not everyone will contribute or will want to contribute their vehicle for convenience reasons, for the effort, lack of financial motive. The most lucrative markets will be covered the first by Cybercab. And so if you live in a remote area where there might not be many Cybercabs, your income potential is also probably limited. So once you start thinking about all the ins and outs, I think this will not be a huge business. Also from Tesla's perspective, it might not be a business they are really keen on pushing because again, you basically introduce a middleman and you cannot ensure consistency of the product, which is the biggest responsibility is that the owner makes sure the car is clean inside and out. But I don't want to ramble on too much about that. You can have a long discussion, and I know minds are very divided on this point, so let's move on. Let's talk about Tesla's ride-hailing network. So that's basically Cybercab, later Robovan, and possibly other form factors. Although right now this is not reflected in my model because I think Cybercab and Robovan really address the vast majority of the market. And Tesla, or I should say Elon, doesn't have really a history of just adding extra products that then serve niche segments. So now let's look at it. So my modeling implies Tesla could achieve a 38% gross margin. And then over time, as network density and especially network effects increase, there is potential that this product achieves over 50% gross margin. And that would be predominantly driven by Cybercab's design, which is highly, highly cost optimized. I've never seen a vehicle that was simpler than a Cybercab. And simple in this case is highly positively connotated. So it will be very, very hard for everyone else to meet that price point where Tesla can still make good money. And therefore there will be I believe, very limited competition, at least in the first few years. Others will try, but my base case scenario right now, it will be similar to the EV segment. They will launch, like in the EV segment, we saw they launched the first and second generation models, and a bunch of them sold them at losses to at least sell some product in hope to at least retrieve some cash gross profit. That's different from pure gross profit, which has non-cash items, COGS, which have non-cash COGS. And I think something similar will happen with all these launching robotaxi ride-hailing networks, or all the Waymos of this world. They will lower the cost, even if it means the overall system is loss-making, just to extract some gross or some revenue that helps cover the cost. And then likely towards the end of the decade, we will see viable competitors, or I should say competitors emerge that have a competitive technology, also super low cost, highly optimized vehicle design, competitive full self-driving. But at that point it's too late, because network effects are extremely powerful. We know them from various kinds of industries where the first mover, the first who gets the network effect, has an enormous advantage. And that was actually, I believe, the primary reason why Elon bought Twitter, because by not buying Twitter, he would have had to start greenfield. Plus, he would have had to compete against Twitter. And by basically buying Twitter, he killed two things at once. He got the social media platform, and number two, he eliminated the main competitor. So last, let's talk about service and other. So service and other was really one of the highlights in the third quarter. The margin hit a record, slightly over 10%. Management talked about it. This was driven by improvements in insurance and the service area of the business. So that's very, very positive. I have to point out there is some seasonality in this part of the business, but we'll talk about it later. There are various other things where I believe that Tesla might actually be able to sustain this margin. And then Tesla benefits from something that, compared to other automakers, this used to be a disadvantage for Tesla. And this is Tesla's lack of a large out-of-warranty fleet. But with every passing day, Tesla's out-of-warranty fleet is slightly growing. And when you extrapolate the number of vehicles moving from under warranty, out of warranty, we're entering soon a phase where these high growth periods from the last few years, where Tesla had massive vehicle volume growth, where a lot of these vehicles that still have warranty are now about to move out of that, and that one will significantly improve Tesla's margin. If you listen to this and you hear, I'm saying Tesla would be exploiting its customer, this is not the case. It's just how these economics work, and given the fact that in a number of areas Tesla's service infrastructure is significantly underutilized. If you look at capacity and how much capacity is spent on paid service. So then let's look at the total. So the total in 2025, I expect overall gross margin comes out around 17%. Then 2026 similar, then improvement in 2027, and then a quite substantial improvement in 2028. And the primary reason is Tesla's ride-hailing, because this comes with, I expect, very high margins. And I just want to make very clear, I'm not plugging like margin assumptions into these models. For example, the ride-hailing margin is the result of modeling in a very high degree of detail all the revenue drivers, and then also modeling a bottom-up all cost drivers, and then coming up with reasonable assumptions around number of miles driven per day per vehicle, how it evolves over time as density increases, how deadheading miles reduce, etc. That's a full economic calculation, and the margin that you see is basically what falls out of that calculation. So now let's move on to some, let's call it operational drivers. So this chart shows you the bridge from third quarter volume to fourth quarter volume expected. Currently, my modeling implies that Tesla will deliver 480,000 vehicles. This is down from 497,000 vehicles. A lot of you might be surprised, okay, how can it be so little if we expect a massive pullback in the US market? So first of all, we have some effect of the fact that people who bought the vehicle in the third quarter can still receive it in the fourth quarter. So Tesla can book these vehicles, so they help a little bit. The second effect is that Tesla launched lower cost vehicles. So these are not only lower cost vehicles, but they look brand new. They have a new look. I read some comments. Some people even think that the back of the lower cost Model Y looks better than of the of the premium Model Y. I think that's highly subjective, but the bottom line is that will have some effect. The other effect, which I think is much more important, is the Model Y performance. If you were a Model Y performance owner, to you, the new Model Y only launched now with the Model Y performance, because buying the refreshed Model Y and accepting buying a lower trim version to you was basically, at least to some degree, a downgrade, because simply you had to accept less performance, plus the little outside changes like the spoil, etc. So for these people, so that there was some pent-up demand amongst this buyer group that knew that the Model Y performance would come and would therefore not buy the new Model Y when it launched in the first quarter. And since this is in general a much higher vehicle segment, the Model Y performance is a lot more expensive than the lower trims, this might also be a less price-sensitive segment of the market. Then I would like to point out something else. So you look at these, here are the totals, and then you see the change. So here these totals, so China, 171,000 vehicles, North America, almost 200,000 vehicles. This number is not correct, but it's on purpose not correct. So here's the thing. All these numbers, they come from a global aggregation. So people who follow me, I post usually starting from the second half of the quarter, detailed breakdowns on how sales develop globally. But at the end of the quarter, when we've add up all the sales for all the countries where we have disclosure, there is often a gap. The issue is that we do not have exact numbers for the US market. There are different outlets that claim, or they sell it, okay, this is the US number, but in fact, it cannot be the US number. And the reason is simple. Tesla reports a number of X. You add up all the markets globally for which we have the official numbers. And then you compare that number with what Tesla disclosed, then you see there's a massive gap. And because we have accurate numbers out of China, registration numbers, and other large market, Europe, and the other meaningful markets, Turkey, Korea, Australia, the only market large enough who can explain that delta is the US market. So basically what you have to do is you have to look at the sources, what they show you for the US market. And for example, for the US market, I saw various sources showing us numbers between 170 to 180,000 units. But we simply can't fully reconcile. So what I decided to do, so what makes the most sense to allocate the remaining unallocatable, if that's a word, units, I decided to allocate to the largest market for which we have the least robust numbers, and that's the US market. And that's why you see the US, the North American number, somewhat inflated. I believe the reality is probably somewhere in the middle. There are certain markets not captured, and there is also reporting inaccuracy in other markets, etc. The bottom line is the true just US sales number is probably a little bit lower than this. And the key point I'm trying to make here is that this reduction of 50, if you assume this is a little bit lower, is actually larger in relative term. Because if you look at this, you think, oh, this is just over 25% reduction. Even though you hear a lot of people talking about this. For example, Ford CFO Jim Farley said we could see a 50% drop in the fourth quarter. Some research companies think it could be 47% drop. So that would suggest that what I'm showing here is a lot lower. But here's the question. Did these CEOs, research companies account for these Tesla-specific one-off effects I just mentioned? On top of that, Tesla's incentives in the US in the third quarter were relatively limited. And what I've accounted for in my forecasting is that Tesla actually provides a lot more incentives in the fourth quarter, which would partially offset the financial, let's call it disadvantage, US consumers now have by buying the vehicle now excluding a tax credit. There are also various other effects, but bottom line is I think it's not going to be not nearly as bad as a lot of people forecast, but still losing a huge number of units, 50,000 units is a lot, is hard to stomach. But luckily, we have a nice offset from China because China fourth quarter is always the strongest quarter. And this year it's kind of supercharged because the the Chinese government is changing some tax benefits for electric vehicles. And electric vehicles will lose half of their tax advantage. And that depending on what vehicle category, this can be around 5 to 10% of purchase price. It could be around 5% of purchase price. So and that's why, of course, a lot of Chinese consumers are rushing to buy the vehicle in the fourth quarter. And so all these effects, plus Tesla Model Y L, the long version, being available in larger numbers, which based on latest data appears to be attracting a lot of probably outsized demand because it effectively just launched in China. Plus there is some boost from the Model 3 Plus. So there are also a lot of little effects that really help in this very important market. And you can see I expect almost 29,000 unit sequential increase in China, for total units to come in China at just under 200,000 units. And then for other geographies, mostly seasonally driven, I expect some slight improvement. And when you add everything together, that basically would translate into just a 3% decrease. The other thing I'd like to point out, the analysts, so the Wall Street analyst community was extremely off in the third quarter. I think a lot of forecasters came in at around 450,000. Bloomberg FactSet, depending where you looked at, was around 450 or slightly above, slightly below. I think UBS 475,000. So all quite off. So there was clearly something completely off in their forecasting. I think, but in their defense, my forecast was also off. I think my final forecast was 480,000 units, so I was also 17,000 units below. The biggest uncertainty is always the US market because there is simply not a great data source. Even the S&P numbers, which are supposedly collected from DMVs directly, appear to be off. Next, we look at the first quarter of 2026. So you have the same chart. Here you see the totals for the fourth quarter on the left-hand side. Again, the 480,000 that I expect for the fourth quarter. And then in the bridge to the first quarter total. So currently I'm forecasting 424,000 vehicles. So that would be another quite substantial drop. At this time, North America, so that's mostly United States, sequential uplift, because the way to think about the fourth quarter low in America is there was demand from the fourth quarter pulled into the third quarter. So that created, let's call it an artificial low in the fourth quarter. But that low, excluding the incentive, should unwind in subsequent quarters. And this is what you see here in North America. So I expect a slight improvement, 4,000 units, even though in the first quarter there are seasonal headwinds. Some parts of the United States are very cold and people typically don't buy very many cars when it's very cold. But then you have a huge headwind in China, and that's basically a complete reversal and intensification of the effects that we see in the fourth quarter. So in the first quarter, China sales always drop massively. There are two always recurring reasons. Number one, China has typically very cold winters. That also reduces sales. But then there's also the Lunar New Year, which is like basically a week-long holidays week where people travel a lot every year. And nobody or very few people buy cars during this period. But the added impact this year will be that this tax benefit I mentioned before is halved. And so you basically see similar dynamics that you see in the United States, just with 1 quarter time shift. And that combined then I expect leads to a massive drop. So for example, if you look at, so I expect China sells 200,000 units and expect basically a roughly 30%, or here you see the number 29% drop. By the way, I misspoke before. I said before, I expect just under 200,000 units. I actually expect exactly 200,000 units in China in the fourth quarter. And just to be clear, this is not just a round number or something. I extrapolate basically on latest trends plus sales development last year and a couple of other market factors. And that's also a number I will be revising later in the quarter once we have more weeks of reporting for China for Tesla. So the next chart is really for people who want to know more about the details, product mix. Here, this chart shows you sales volume. Please notice excluding leasing. For modeling purposes, for clean numbers, you always want to exclude the leasing business and model leasing separately, because the accounting effects of leasing are quite different from an outright sale. I will not walk through all these numbers. It would take too much time. I would just like to point out, I expect very limited progress in terms of Cybertruck. I expect some geographic expansion over time and some market expansion as Tesla improves the vehicle over time with enhanced battery chemistries and other things. as they have done just with all the other products over time. Also, my forecast reflects basically no meaningful upside from S and X. And these are completely non-needle movers to Tesla anyway. Down here you see the expected, and this is a very important assumption, I assume Tesla will sell also Cybercabs. So what you see on this slide is not a ride-hailing network. This is Cybercabs Tesla sells to paying customers. Because I think there would be a massive market for it, because not everyone wants to ride in a vehicle that is full with DNA from strangers. And people with money would love to have a Cybercab for their own use, because it would be the ideal vehicle for your teenage kid that is not a great driver. Selling Cybercabs also makes, from a financial, let's call it engineering perspective, also a lot of sense, because it would help offset the cash burn from rolling out Cybercab fleet, because it takes a couple of quarters before a Cybercab can recoup the cash outlay, and that's why rolling out Cybercabs for robotaxi use and selling Cybercabs to the public would make complete sense, just from a prudency perspective. Then next, let's look at the ramp of Cybercab. I expect very few units. As far as I know, Tesla has already started production. Also, Tesla appears to be on track. I mean, in terms of being right on schedule after a delay. So the limiting factor right now appears to be FSD, not Cybercab. But my forecast assumes that in the first half of next year, that, let's call it, software bottleneck will be solved. And as soon as that happens, we'll see meaningful numbers of Cybercab rolling off the production line. At this point, I also want to point out some, like, let's call it strategic point about modeling. So when you look at my Cybercab modeling down here, you might say, oh, maybe it's so aggressive that there's at least a very slow start in Q1. Maybe it only starts very slow in the third quarter. You should think about this in slightly different terms. So right now, everybody expects so early next year start of Cybercab production. Should there be a delay, we'll likely find out not far away from that expected launch point. At that point, so in other words, we would be already sometime early 2026. Should it shift by 1 quarter? Sure, there might be some negative reaction, but the big picture is there will be the carrot in front of the investors dangling, the launch of the Cybercab. So who would be selling? So basically, investors will just put up with it. That's why when it comes to these launches, you want to be slightly more aggressive to account for this, I don't know what to call it, this drag effect, dragging something out. Because that probably lines better up with then sort of the later share price reaction, because this is what this all is about. I hope I'm making myself clear. So next we look at aggregated key assumptions. So now you look at total deliveries excluding leasing. So for the fourth quarter, I expect 460,000 units, again excluding leasing. My total is 480,000, so there would be roughly 20,000 leasing sales. Average selling price, again, this is all modeled up by model, trim, geography, etc. But when you do the calculation, my average selling price comes out significantly lower in the fourth quarter, going down from $41,600 to $40,300. There are some key drivers here. Number one, we had in the third quarter a very large share of US sales. US sales are higher value sales. Model Y sells for higher price than in certain other very large markets, i.e. China. In the fourth quarter, we have a completely reversal. The large share of US vehicles drops a lot, while the while the Chinese market significantly increases. That alone creates a significant dilutive effects on the average selling price. However, don't worry, the flip side is that the average production cost will benefit from that. So that's one effect. The other effect that pulls down the average selling price is my assumption that Tesla will very aggressively be pushing volume in China and of course in the United States and other markets, and that will of course have a negative effect on the average selling price. And then down here you just see the revenue. So in Q3, Tesla generated 1.3 billion in automotive revenue. So this is pure automotive sales. You can see here on the right hand side where you can find that item in the income statement. And then in the fourth quarter, due to the effects I just explained, there will be a meaningful decrease to 18.6 billion in revenue. The other dilutive effect I haven't mentioned, one has to account for, is the effects of the launch of the lower cost models, of course. So this next chart shows you average selling price assumptions per model. So this is the volume weighted average price per model, but is derived from a model price matrix based on geography, because prices, for example, in China, Europe, and US are quite meaningful different. Plus, you have to account for currency effects. So let's have a quick look. So the price changes that you see here in Q3 are mostly driven by volume shifts in the different geographies. Again, United States was very strong. That offset certain one-time effects. And please note that the price that you are seeing, these are effective prices. These are not the price tag that you see, or sorry, the price on the website. This accounts for various deductions depending on jurisdiction. For taxes, for example, in Europe, in all countries, vehicles prices are shown including VAT. This is not the number Tesla receives before Tesla accounts for revenue. Tesla has to take out that amount. Next, we look at FSD subscription revenue. So what you have to consider is that this is really only relevant for vehicles that have at least hardware 3. So at the end of Q3 2025, that fleet grew to 7.9 million vehicles. And since this only affects a subset, so hardware 3 or higher vehicles, the growth rate of that FSD capable fleet is actually much higher than what the volume growth would imply of total sales, because the denominator is smaller. And when we look at adoption rates are still quite small. Then I'd like to just remind everybody about something Elon said in January. Elon said we're going to have to upgrade hardware 3 and then I cut the rest for people who bought the FSD subscription. I estimate might be only around 150,000 units. But by him saying they have to upgrade it means there will not be a version that will be fully autonomous for hardware 3. And therefore, whenever you talk about the ride-hailing network where owners contribute their vehicles, this only affects hardware 4 or above vehicles. So you have to keep this in mind in your modeling. So next, we will run into a little bit of a problem. So on the third quarter earnings call, the CFO said that Tesla, and I quote, a total paid FSD custom base is still small, around 12% of our current fleet. There are a few issues with that. I will cover this in a dedicated video because it's a very important point. I'm not saying what Tesla said is wrong. It just has certain ramifications. So I would just park that item. And once I figured out how this actually works, based on various other data points we got and what conclusion we can draw from it, I'm happy to reflect it. So what the CFO said would imply that Tesla has globally about 900,000 FSD users. But I will follow up on that point. So let's talk about the financial effects if it was really 12% as we understand it by the comment that the CFO made. Because there could be some issues with the definition, but let's assume it is what one would automatically assume at first glance, hearing it. So the fleet was just under 1 million units, or just under 1 million subscribers would use it. I estimate the delta between what you see here and 1 million unit would be around 200 million in gross profit. And let's assume a very high software margin, 95%. So there would be 190 million in additional gross profit. Even though Tesla did not mention it on the call and it did not disclose it in the notes, this could be why Tesla's service and other margin was so exceptionally high. And to show you what I mean by that, let's just jump to that section real quick. So you can see down here the gross margin service and other. And because this FSD subscription that's split out for modeling purposes, may not, because Tesla doesn't disclose it as of now. I think they will in the future, but right now they don't because it's still too small. This increase in fleet adoption might be part in addition to what Tesla disclosed, what was driving the margin, what created this massive spike to rounded 11%. In reality, it's just under 11%. So that would make sense. So now we are back to FSD subscription slide. So this is a point that warrants more investigation, but unfortunately, as far as I know, there's very limited data. So stay tuned for my update just on that element. So here next you see more breakdowns with regard to FSD subscription, as we just established. Based on what the CFO said, my forecast or the numbers that I'm showing here is basically way too low. So there would be a lot more subscribers. Keep in mind these are just subscribers. This excludes people who bought FSD. So in other words, if, as we just based on what the CFO said, there should be around 900,000 FSD customers. He called it total paid FSD customer base. Total paid, I think, accounts for both people who have a subscription and people who bought the software package. People who bought the software package would not be in my forecast. If, and that is the big debate here, if people who bought the subscription would be basically 3 times more than people who subscribe, which appears unlikely, then my subscriber estimate is too low. So now the question is, what is the distribution between people who just subscribe and people who bought it? So overall, I think if my number is too low here, I think it's not too low by very, very much, unless you assume a very high subscriber share. And the argument against a very, very high subscriber share would be that there would be relatively large recurring revenue, and it would reach a level where Tesla is not exactly forced to disclose it, but had an incentive to disclose the recurring number. Next, we just look at the monthly subscription fee. So currently it's $99. Over time, I expect a slight increase in line with inflation, plus some increases to adjust for performance increases. And then we would see the implied FSD subscription revenue. So I'm forecasting 98 million. This is a very high gross margin revenue, of course. So there could be maybe 100 million missing, but we have to be careful that there's no double counting with the service and other segment. Based on a roughly 5 billion gross profit base, 100 million would only introduce a 2% error before tax and an error of approximately 1.4% to EPS after tax. So in other words, it's not a massive needle mover right now, but it's an item I will investigate more. So the next slides, they discuss automotive leasing, but because this video is already getting quite long, I just show you the slides. There are a lot of notes. They explain how the leasing business works. Just in a nutshell, almost all vehicle leases from an auto seller, they are classified as operating lease. There are very, very few exceptions. The vehicle is then recorded at cost and is depreciated. Leasing sales are not that attractive because they have a poor cash flow profile, since cash is received only over time, while making and providing the car to the customer creates a large cash outflow day one. Plus, leasing sales come with all kinds of other annoyances like uncollectability of leasing payments, etc. Last quarter, Tesla only had 10,200 leasing sales. It's very, very low. Again, this is not total leasing sales of Tesla, but just leasing sales on Tesla's books. And then there's always what's called attrition, so basically old leasing contracts that are running off. And so the new additions in a quarter plus the old contracts running off, the net amount adds or subtracts from the leasing fleet. And in Tesla's case, that leasing fleet was globally, as of end of Q3, only at 170,000 vehicles. That's quite small. The way to think about it is you think about the total Tesla fleet is around 8 million, over 8 million vehicles. So 170,000 vehicles is roughly 2%. Next, to calculate the economics, you look at the leasing fleet, you look at the average leasing revenue per vehicle. This has dropped significantly as older, higher value contracts are running off and being replaced by cheaper, lower value leasing contracts. And that together basically results in a relatively steady leasing revenue. Now we get to regulatory credits. Down here you see in billions what Tesla recognized. In the third quarter, this was just over 400 million, so a substantial drop compared to last year. And my forecasting expects a further slight decrease over time. So my forecasting, in other words, does not rely on substantial credit sales in any way. And this reflects the end of the US credit sales. But I have to remind everyone, Tesla not only earns credits in the US, but also in a lot of other large markets. And the CFO talked about this. He said in the most recent call that while regulatory credits declined sequentially, we entered into new contracts and continued delivery on previously entered contracts. And right now, when you follow regulatory developments, so at least for the rest of this year, there's no risk to credit sales in Europe. It's a large credits market, but also the credits that Tesla can earn in the Chinese market. So on this slide, you see the assumption for a semi-truck. So I expect from basically first half of next year, there's a kickoff, very limited production going to selected customers. You see here the average selling price assumptions. Because the video is very long, I kind of speed up now for the rest. So please have a look at these slides. There are a lot of notes that hopefully cover the most important points. Next, we look at energy storage, and I think we talked about this already quite a bit. Up here you see deployment. So the third quarter came in at a new all-time high. I expect the fourth quarter to be yet another all-time high. And my outlook is heavily guided by what the CFO said. So the CFO said that Tesla is expecting over 50% year-over-year deployments. That is exactly what you see in this chart. I'm forecasting 53% year-over-year growth, 48 gigawatt hours. After the gigawatt hours that have been delivered in the first 9 months, that would imply about 15 gigawatt hours in the fourth quarter, so a very strong quarter ahead if Tesla meets its guidance. Then you see the average selling price per kilowatt deployed. In the third quarter, this decreased to $257 per kilowatt deployed from $269. But as you can see, in the first quarter, we already at one point dropped to $243 per kilowatt. I think the strong pricing development we saw, especially in the second quarter, was driven by substantially increasing demand from hyperscalers. And keep in mind, revenue recognition always comes with quite a substantial delay. So projects that have been recognized and affect these selling prices, they have been built much earlier. And then based on the implied on the deployments and the average kilowatt price assumption, you then see the implied revenues. On the third quarter, Tesla generated $3.2 billion in energy storage revenue. And these assumptions you see in front of you, they imply a substantial increase in the fourth quarter to $3.8 billion. And then when you look at the year-on-year growth numbers, so my forecast implies a 42% growth next year to $17 billion, and then a slowdown thereafter. But I'd like to point out this is just a slowdown in revenue growth because I expect competitive pressure will reduce average selling price that is achievable because the margin is very high right now. And but when you look at the deployments, I still expect quite strong deployments, 50% growth next year, 51% growth next year, then 24% growth the year thereafter, and another 20% the year after that. So next we get to robotics. Of course, it's a topic that everybody is super interested in because that product has enormous potential. However, as you can see here in the model, there's basically no financial impact from robotics, because I think throughout this forecasting period, which goes out to 2028, we're still kind of in a ramp phase. You can see here in the units delivery assumption, the forecast accounts for 5,000 units to be delivered to customers end of next year. I think. And then the average selling price, my current assumption is Tesla starts with $28,000. This might sound very high to many of you, but keep in mind what Elon not long ago said. The cost of the bot is substantially driven by what inferencing compute you're going to use. And knowing Elon or having followed him for a long time, I think he'll be shooting for a highly capable product, but one that makes sense. So not all the bells and whistles, but one that basically provides the most value for the buck. And then down here you can see what that means in revenue impact, which is quite small. A kind of a simplified way to how you can think about Optimus. This $28,000 price. It's like selling a cheap car. Then when you look at these units, 5,000, 6,000, or for the full year of 2027, I'm forecasting 32,000 units, 32,000 extra sales of a cheap car. In the grand scheme of things, doesn't make that much of a difference. It's a complex product, so in the beginning, the financial effects will be quite immaterial. And by the way, this ramp that you see, this is something I derived from Elon's guidance. He talked about a certain time frame he expects to achieve 1 million unit run rate, etc. I applied a 20% haircut to that goal achievement. Elon, of course, everybody knows it, slightly optimistic on these things, so it's prudent to apply some haircut. So this is reflected in this modeling. Next, just a quick reminder, very important. I've shown this slide before. This slide shows adoption curve of new groundbreaking technologies for their time. And what's often missed when people talk about S-curves is that number one, they start very, very slowly. The people always, when they talk about S-curves, they think about this super high growth phase, but there's always this very slow tail. However, the other phenomenon that we can observe that adoption curves tend to compress, so they happen faster. So it also reduces the slow initial tail, but there's still probably a slow ramping phase because ultimately customers need to warm up to this new type of product. Plus, they also need to start replacing what they have with the new system, because a factory built for just humans and highly optimized machines requires basically, if you have a set system, that you remove the humans and put Optimuses in. This might not be as straightforward as people generally assume. So where we then go into the super high adoption phase is basically where people start designing production systems with Optimus in mind, but that will be a next phase. But again, for the time horizon of this forecast goes out to 2028, there's basically no material impact in terms of financial effects. So I think that the biggest advantage or the biggest point to consider for investors is really what this creates in terms of a dangling carrot in front of investors, because that of course will support the story for the next couple of years. And for everybody listening to this and is doubtful about this product, let me tell you, I talked to a lot of people in the global supply chain, especially in the semiconductor supply chain, and I can tell you all these companies have working groups working on this, and internally teams fighting over who is being put in charge to run the humanoids project. So even though this might, for people who are not in touch with these industries, might think, oh, this might be, looks like a toy right now. No, this is really being taken very, very serious. Next, here we see the details of the owner ride-hailing revenue drivers, so where the Tesla owner contributes his or her vehicle to the Tesla fleet for a robotaxi application. Keep in mind, this only touches hardware 4 or above vehicles, based on our current understanding or based on what management told us. Over here you see the contribution rate assumption, which means what percent of Tesla owners who have such a vehicle would be willing to contribute to such a fleet. I think in the beginning it's really mostly early adopters, and then over time there will be some increase in acceptance. But keep in mind also regulatory effects. Even though maybe in the US adoption might be substantially higher than what you see here, globally the adoption rate might be diluted because in certain jurisdictions it still couldn't be launched. And then down here you have mathematically what would be the contributed number of vehicles. And then here on this next slide with the contributed number of vehicles, you can then apply a monthly revenue assumption, and from that you can then derive the revenue. And here in the notes I left various comments on how the monthly revenue assumption was derived. Next we talk about Tesla's ride-hailing. So this is going to be moderately near term the most interesting piece that is actually delivering material financial results. And as I said earlier, I expect those to kick in meaningfully from the second half of next year. So my modeling currently assumes that the supervisors will be removed in most areas, at least in the United States, sometime in the second quarter of next year. And then down here you see the average ride-hailing fleet. So here these tiny numbers is basically when Tesla started in June rolling out based on Model Y some additional vehicles. So it's still a very small scale. And then the fleet size kicks off as Cybercab production kicks in. Then with the average number per quarter in the fleet active, and then an assumption of how many miles the vehicle is driving. And importantly, you need to pay attention to the average paid miles driven, which is vastly different from the total miles driven of the vehicle. We can imply the revenue, and you can see as the fleet grows and the average paid miles driven also increases, this reflects the effects of network effects, densification in high density markets, etc. And customers a greater familiarity with the product, i.e. a very cheap Uber or taxi alternative, we should see an increased utilization of cybercabs. By deriving these assumptions, I also used heavily various comments Elon dropped over the last couple of quarters on this topic. And next we talk about the service and other segment. And here, just to repeat for everyone, so that segment currently, as Tesla reports it, comprises a lot of things. So number one, used vehicle sales are included in this segment. So a lot of people trade in their Tesla when they get a new Tesla. So Tesla then sells this traded in Tesla as a used vehicle. Tesla also books in this segment non-warranty after-sales vehicle service. That's the item I explained earlier that is bound to grow as more and more vehicles start to move out of the warranted fleet into the non-warranted fleet. Tesla also books body and part sales in that segment. Tesla books its paid supercharging. That's also a sector that should, with the ever-increasing electric vehicle fleet globally, should also see some positive tailwinds. Then there is Tesla insurance, vehicle insurance, and here I'd like to point out that the CFO mentioned that item in the third quarter call as a key driver of the strong margin. So that was quite interesting. My suspicion is that in the last few years we saw very high combined ratio. So this is basically the spend of an auto insurer, really simplify. And the combined ratios were over 100%. That meant the insurer lost money on the underwriting business in car insurance. And Tesla may have been also affected by this, and Tesla may also have underpriced its car insurance. And it's possible that that this weighed on the service and other margin, and actually the very strong service and other margin we now see is kind of Tesla figuring out the insurance business. And because the insurance prices substantially increased in the US auto market, you can, for example, see this in the CPI report. This much higher car insurance price level may have enabled Tesla to also raise its prices to a level, or just figure it out how it works with probably AI, to basically reduce or eliminate losses, or even generate a profit with its insurance business. And then the last item that's included is retail merchandise. So in one way you can model this is you take the entire fleet, which you see up here. So at the end of Q3, Tesla's total fleet was 8.5 million units, and the average service revenue across that entire fleet, again, supercharging, etc. You can debate about the drivers, was about $410. I expect this to slightly increase before it reduces in the first quarter. I think Tesla has seasonality in this business. For example, in the first quarter, people tend to drive less because of winter, etc. So there is less supercharging, and there are various other seasonal factors. But then you see that I forecast a recovery of the average revenue. And then from the average revenue and the fleet size, growing fleet size, you can infer the revenue. So next slide shows you the cost drivers per model. Again, this is on a volume-weighted, trim-weighted basis for the key different regions. That's China, Germany production, of course, US production. So when you look at these numbers, and especially at the key products, so the Model Y and the Model 3, I'm expecting in Q4 a very slight decrease. And you might wonder, oh, why is it just so little? Even though I said earlier that the improved, or the mix with more China vehicles should bring down the average cost. The offsetting item here is that the overall volume decreases, so there is there's less volume over which to distribute the fixed depreciation charge. So that's number one. Number two, there will be an amount of ramp-up cost for the lower cost vehicles, both in the United States and in Germany, plus the launch of the Model Y Performance. And given what I explained earlier, that I expect some pent-up demand for that vehicle to release, there will be, at least it's my expectation, a slightly higher share of Model Y Performance, which have a higher production cost. So none of these factors in itself is a massive needle mover, but if you add all of them together, they partially offset the mix effect from higher China share. So the very high cost that you see down here for Cybercab, so just under $40,000, that is primarily driven by depreciation charges. So I expect Tesla to have built a quite amazing production line for the Cybercab. That will also not be cheap. There's hardly anything amazing that is really cheap to make in manufacturing. And because the unit volume will be very low in the beginning, there's just very units over which you can distribute that cost. because the depreciation charge is on a straight line. That means there's a fixed amount each quarter. So the fewer the units, the bigger the depreciation charge per unit. But you can see as the volume increases, I expect there will be a very quick improvement in the cost. And currently my base case is once the line fully ramped, Tesla might be able to make this vehicle for $18,000 because it's so incredibly cheap. Sorry, I shouldn't say cheap. It's highly optimized, and which resulted in a very cost-effective vehicle. And we see in a moment why that is so crucially important. Before we do so, let's just take a quick look at the production cost. So this is the blended overall production cost. You see the net result is I expect a slight decrease. The average vehicle price, I expect a stronger decrease, as we discussed earlier, due to incentives and other effects. And then down here you have the implied gross margins. I expect quite a drop in gross margin. But again, the EPS should still hold due to the various one-off effects I expect to unwind, and other effects, strong energy, etc. So you can see we are increasingly moving into a period where other parts of the business help increasingly offset temporary weaknesses in the pure auto business. Here on this slide, you see the gross margin assumption on the on a per model basis. Not really worth discussing because that's basically implied from the average selling price and average cost assumption that we just looked at. So you add the two together, this explains the gross margin profile that you see in these vehicles. Just one point to point out, it's not really a needle mover, but here Cybertruck has a negative gross margin, and the main reason is Cybertruck currently is sold at such low volumes that the high capacity production line Tesla built is basically completely overbuilt and incurs a very high depreciation charge. So in terms of cash, it's not a problem because that cash for these machines has long been paid out, but it just creates it's called an accounting headwind. This chart just summarizes the key metrics for the automotive business. So automotive sales, so the revenue, then the margin, and then the gross profit. Now we get to the cost breakdown of the cost per mile driven. So the CPM, that's a key metric. Here on the slide, I presented this slide before. I have not made any changes because I felt like there was nothing to be updated, frankly. So I will not go through each item yet again. I just want to point out the key observations. So the overall cost per mile from this bottom up driven is very important, not paid mile. I come out just under 16 cents per mile as of the first quarter of 2027. This is in the future for various unwinding effects explained also in this deck. But when you look at the cost contributors, you can see here the numbers. So 7.2 cents based on this economic calculation of the vehicle value, useful life, etc., is the biggest cost driver. It's not So basically what people think about in terms of fuel cost, electricity, does not even make number two. Electricity cost, etc., only comes in at number three and is not even half of the effect of the vehicle cost. And that shows you why optimizing the vehicle is so incredibly important. If you start off with an expensive vehicle, you have a huge cost advantage. And that's why Tesla's Cybercab, I said this many times, is so brilliant, because it's brutally optimized for efficiency. They give it low maximum speed, so they can make the tires that they can give the tires less rigidity. This increases efficiency, reduces weight, reduces cost. They can make everything weaker, but don't misunderstand this as a bad thing. This will still be a 5-star safety rating and everything. But if you build a vehicle just for a top speed of 130 kilometers an hour, or 80 miles an hour max, or 75 miles an hour max, you can save so much weight. And then battery, etc. So we could talk about Cybercab for an hour easily. So I will move on from here. The next part is cleaning. So when Tesla presented the Cybercab for the first time, on the 1010 event, it was not an accident that Tesla presented at the same time automatic system for cleaning the vehicle, etc. Because cleaning the vehicle will be a quite substantial cost driver. And I think, it's obvious, Tesla will have done the exact same calculation, and they also will have seen, cleaning will be a big deal, so we better, because when you think about the whole vehicle system, it's not only Cybercab, it's not only the production system, but when you think about robo-ride-hailing as an entire system all under Tesla, it starts with the production system. You have the vehicle, but then you have all the downstream elements to make the overall system work. So production system and Cybercab is only one piece of the overall autonomous robotaxi system. And cleaning is one part of that overall system. And let's be not cute about this. There are some Tesla haters. They will happily take a cheap cybercab, right? But when they leave their vehicle, they will leave something behind. We already know 100% for certain that will happen. So I expect Tesla to have systems in the cybercab that can detect a contaminated vehicle and then basically take it out of service, move it back to a service station for cleaning. So this chart just shows you the evolution of the cost per mile flowing through the model. You see the first quarter here highlighted. This is on the breakdown that we looked at on the prior slide, and this just shows you the evolution over time, because there are various time effects and scale effects you need to account for. I skipped the details of this because I want to save a little bit of time, because this video will be already super long. So now with the CPM equipped, the cost per mile, we can move to the next stage. The next stage, and this is a very, very important assumption, is the deadheading miles assumption. So what share of total miles driven the vehicle drives around empty with no paying customers in the vehicle. And you have to think about it. The vehicle has to pick up the customers, and especially in the beginning when customers density might be low, they might be far away. The vehicle will be driving around a lot of the time empty. And I heavily leveraged information from Uber and also the taxi industry on this point. And it turns out deadheading shares depend very significantly from market. High density markets like New York have a very low deadheading ratio, while large spread out cities tend to have much higher deadheading share. Overall, I think long term, as cybercabs have the potential to unlock a change in consumer behavior, because relatively few people still use taxis and Uber because it's simply too expensive, that as more customers can be penetrated with a much lower price. Sorry, I should not say it this way. I should say as long as once more customers can be reached with a much lower price. I think that sounds better. Then the customer density will increase, and then deadheading miles should drop below what is currently achievable with a taxi network. I think that's a plausible assumption and probably conservative assumption. So I might still be a little too conservative here. Also, AI systems will improve vehicle positioning, which should also help reduce deadheading mile, because when you run the numbers, this assumption, so deadheading share, makes a huge impact on the economics of the overall system. And then we get to the cost per paid mile. So with the cost per mile driven and the assumption of how many miles are being driven empty, you can then derive the cost per paid mile. And it's very simple. If, for example, if you look here, if the cost per mile is like 20 cents and you drive half the distance empty, that means the cost per paid mile is double. So you have almost 39 cents or almost 40 cents cost per paid mile. But you can see very clearly, as the deadheading share drops, the cost per paid mile substantially approaches the cost per mile. That is the key insight, and that is a key economic factor. And that's why I think once Tesla gets into the level where it achieves real customer adoption, network effects, etc., in high density markets, there will be a sudden spike in profits in the system. Next, we have to talk about operating expenses, and the key driver in operating expenses is research and development expenses. So in the top chart, you see what Tesla spent historically on R&D as a % of revenue. You see here massive spikes. This is mostly driven by substantial changes in revenue. So for example, in the third quarter, revenue was at all-time high, so the ratio dropped, only 5.8% of revenue spent on R&D, but this was a function of very high revenue. And down here you see the absolute amount, and Tesla spent for the first time over 1.6 billion on R&D expenses just in one quarter. CFO talked about it. This was in part driven by awarding equity awards, so there was high share-based compensation in that quarter. That's what he meant, and that was for AI talent. And as I said several months ago already, Tesla will not be immune to the crazy compensation hikes that we see in the industry for AI talent. Of course, Tesla has to incentivize their people. From what I've heard, Tesla pays quite competitively, and this is the strength of Tesla's huge market cap. Tesla pays a lot in share-based compensation, but because the market cap is so high, this comes with relatively little dilution for Tesla. So in other words, Tesla's huge market cap is a massive competitive advantage and enables Tesla to play in a, let's call it R&D league that is much higher than what Tesla's financials will actually support on its own. And sorry, now comes a little rant. That's why I find it always so silly when people talk about things like, Elon keeps on purpose Tesla's share price low when something happened that depressed the share price for whatever reason. If there's a post, whatever it is, it's from a strategic perspective, it would be really, really silly because it has real negative impacts on the business. So Tesla has a strong incentive to keep the share price very high. The way to think about it, it gives Tesla a very strong currency with which they can compensate key personnel. Next, we talk about the second most important driver of operating expenses. So this is SG&A spend, so selling, general, and administrative expenses. So this includes marketing, all selling expenses, management expenses, etc. Everything else to basically run the business. Here again, at the top, you see a relative metric. You see how much Tesla spends on SG&A relative to total revenue. So in the third quarter, this was 5.6%. You can see Tesla has managed that ratio down in the last couple of quarters at 1.2 to 4.7. That was an outlier quarter. This was right after the Tesla's ever biggest restructuring, which was in the second quarter of 2024. So then it has increased. I'd like to point out that some SG&A spend, and let's now look at the absolute numbers. You see down here, Tesla spent in the third quarter just under 1.6 billion in SG&A, and you can see there was quite a substantial increase. And that number, when you read Tesla's notes in the SEC filings, there was a large legal expense in there, and there was additional spend for preparing the shareholder meeting in November. I think the people that some shareholders noticed that call around trying to get people to vote and other such activities. I think all these activities were expensed in the third quarter, and they should disappear in the fourth quarter. And so the bottom line, I expect these one-offs, that supercharged SG&A spend will partially unwind. However, part of this increase is driven by Tesla's all-time highest volume because some spend is associated with selling vehicles effectively, so commissions and similar. And so there was all-time high here. There's a reduction in volume in the fourth quarter, so this should bring down SG&A spend, especially given that the volume reduction is in the US market where the commission is higher. Plus, there's not this litigation charge probably not recurring in some other smaller one-off items. So that's why I feel confident that SG&A should decrease. But then when we look sort of long-term, there are various seasonal factors. And then, of course, with this growing scale of the business and also inflation effects and other things, over time, it will grow. But relative to the total revenue generation, you can see up here in the relative metric shown here in percentage, you see over time expect an improvement in efficiency. And that will also be supported by AI. So next we have to talk about tax. So the chart you're looking at now shows you the effective tax rate, and that one was very, very high. So the all-time highest effective tax rate Tesla reported in the second quarter of this year, it was 29.2%, and now in the third quarter it was 28.7%. You also see this massive spike in tax rate that followed the first quarter of 2024. There was a big shift in how Tesla accounts for certain tax matters. I will keep it very simple here because we could dig into a lot of detail, which doesn't really matter. The big picture you should keep in mind is after this tax change in Q1 2024, Tesla brought its tax reporting more in line with other S&P 500 companies. And that should have given Tesla a tax rate of around 20%. This is also exactly what we see in the subsequent quarters. However, come 2025, there were other tax changes. And then we had the signing of the big, beautiful bill, which had also various additional tax ramifications. This forced Tesla to recognize certain things. And there, as I understand Tesla's tax notes in the SEC filings, there were certain one-off items. So my take is that Tesla's effective tax rate will come down in the fourth quarter. A big part of it is there will be less revenue from the US, which is a higher tax jurisdiction. So that's one driver that will help bring down the ETR, effective tax rate. But then there were also a beautiful bill-related one-time effects or one-time value adjustments. They go away. So the overall net effect is that the going forward the tax rate will be permanently elevated, but it will be not at the level of the third quarter. So there will be actually a slight positive tax effect in the fourth quarter, and that also helps us a little bit with the EPS, because the EPS is a post-tax number. So if the tax rate is higher, all things being equal, the EPS will be lower. This is also always why the market rallies if there's like a big tax cut. For example, during Trump's first term, when he announced a big tax cut, there was a massive rally in the market, which, by the way, my former boss, Gary Cohn, executed for him. But I digress. So next we talk about Tesla's deferred revenue on Tesla's balance sheet. So this is an amount that is that investors often ask me about. At the end of September, so the most recent reporting date, that amount grew to an all-time high of 3.8 billion. And investors always ask me, okay, when does Tesla release this honeypot? Because investors think this is all or mostly deferred revenue from FSD. So when people bought FSD, Tesla has not yet met what's called the performance obligation in full, and hence let's say Tesla takes in, making up a number, $10,000. The performance obligation is met, let's say 80%, then Tesla can immediately book the 8,000, but has to defer 2,000 until the performance obligation is fulfilled. And recently a number of people asked me with Tesla's latest version release, improved performance, should we expect a significant increase in the release? And the short answer is, based on historical data, the answer is no. And first of all, and I prepared 3 slides to show you exactly what I mean. First of all, what's actually included in deferred revenue from automotive. So this does not include energy. So this is only for the automotive business. And down here you see all the items. So first of all, it includes, as what everybody assumes, FSD features and their ongoing maintenance. Keep in mind, their ongoing maintenance. So even after FSD works perfectly and they have met what people trivially assume as the performance obligation, Tesla will still retain a share of the money, because Tesla needs to ensure that for a certain amount of time, and this is an assumption Tesla, as far as I know, has never disclosed, but they have to make for accounting purposes, has to put aside money for that. So even if FSD works perfectly, there is not 100% release. So this is first observation. Secondly, this balance also includes internet connectivity. So this is basically, in the insurance industry, you could almost call this float. This is just you pay for internet connectivity, and Tesla provides it over the months or some other time period, internet connectivity. So this should not be a huge amount, but given Tesla's large global fleet size, that ongoing float will also make up a meaningful percent and should be growing. So next, free supercharging programs. You probably have seen not long ago, Tesla launched Model S and Model X with lifetime free supercharging again. So this would also add to this balance. But then also, Tesla retains from every sale, not only FSD sales, over-the-air software updates. Because of course, Tesla vehicles are highly computerized. They require software updates to keep the fleet running. So Tesla has to set aside for the entire fleet some money. So now the big question is, okay, after you account for all this non-FSD stuff and for the FSD stuff that stays even after FSD is perfect, how much of the 3.8 billion is actually, let's call it, releasable FSD deferred revenue? I think right now nobody knows except Tesla. So another way you could look at it is you just cross out of your mind FSD for a moment, and you think about, okay, what's the reserve Tesla would have to create for internet connectivity for the entire fleet? Probably most people pay for internet connectivity, I would assume, because it makes the vehicle much more capable. And keep in mind, there are over 8 million vehicles globally, so that's probably not an insignificant amount. Then the free supercharging, also the over-the-air updates for probably not the entire fleet is captured, because some vehicles are likely too old, but probably for several million vehicles, there is an amount allocated for at least a couple of years software updates. I don't know the answer to that thought experiment, but it's probably might run into the billion. So there might be a significant portion that is not FSD related, but we don't know. But I think the point is not the entire amount will be releasable. Then there's the elephant in the room that is typically missed by people who try to promote that point, in my view, too much. This is a non-cash item. Tesla receives the cash. It's in the cash flow statement. It's in the cash and cash equivalents. So if Tesla releases this reserve, it will be a very low quality item because it's ultimately only boosting profitability metrics, but there is no cash associated with this. So even if it was released, it would only be a cosmetic effect to some margins. It would also lift EPS, but it would be a low quality EPS driver. And I think a lot of people completely ignore this critically important aspect of this item. However, deferred revenue balance development is not only an item to assess whether there could be financial upside, but people also look at it to get a sense of what could it tell us about autonomy or the maturity state of FSD. However, there's a much better metric. And that metric you see on this slide. So this slide, it's slightly complicated, but what it shows you is what Tesla tells you in the SEC filings, what they expect to be releasing over the next 12 months from the reporting date of that report. But they also disclose what they actually recognized in the quarter. So what we can do is we can go back and we can compare what they estimated and what they ultimately ended up recognizing. And when you look at this chart shows you the delta between these two numbers. So when the bar goes down or is in this gray number, the guidance was much higher than what was actually delivered. So there was a deficit. If what was later recognized was higher, it outperformed guidance, as shown here in this blue or teal color in positive numbers. And the way you could interpret these metrics, and again, there are no assumptions, this is just purely derived from Tesla's reported financials. The interpretation would be that, for example, in 2022, Tesla vastly overestimated how much they could recognize. And you could potentially say, okay, so they overestimated the progress they would make with FSD. And of course, now with the benefit of hindsight, we know that was indeed the case. And then 2023 came around, and with 2023, the launch of version 12, and version 12, if you remember, represented a first real leap forward that was really AI driven, and that solved many previously basically unsolvable issues with human coding. And all of a sudden, Tesla started to recognize more than what they guided for. But you can see that by how it later then turned the other way again. And I show you one other data point that is important to fully get the picture. Tesla may have been a little bit too optimistic after the launch of V12. So progress apparently didn't improve as much as they thought, as inferred by these numbers, because we then see these quarters with quite material underperformance. So in the fourth quarter, there was significantly less than what they guided for. First quarter of 2024 was in line with guidance, basically 1 million more. And then there was a substantially lower recognition in the second quarter of 2024. And then there was, again, a sort of a miss in recognition in the third quarter of 2024. And now comes the problem. We cannot calculate the fourth quarter of 2024 first and second because we do not have a full next 12 months period. That's the downside of this analysis. However, we can get a little bit more insight if we do the following. So this chart now shows you the guidance I was talking about. So this is not showing you the delta, it shows you the absolute amounts that you can compare with each other. So that there's the guidance for, and again, the way to read this is the every dot that you see and the respective number is what Tesla said they would recognize over the next 12 months. And then that dot shows you what was actually recognized. And for example, if we look at this, what is this, third quarter of 2022, you see here what was reported or recognized was between 700 and 800 million. And then, but Tesla guided for 13 to 1400 million. So that's about a 600 million delta. And if you go back to the prior slide, this third quarter of Q2, this is the number that you see here. So that's huge gap. It's the delta between these two lines. So just to make clear, everybody gets how to read this chart. And then we can compare how the guidance, so this blue line compared with the actual delivery, and we can see that before V12, before Tesla moved to AI, there was a huge gap, huge overestimation. So guidance was much higher than what was actually delivered, and that lines up with the actual experience with FSD. There was quite a lot of progress, but simply not as quick as I think both Tesla and investors hoped. And then from rollout or after rollout of V12, we see sort of a substantial narrowing of the gap. At some points, Tesla outperformed, as we just looked at earlier, but then started underperforming slightly. And then this dashed line marks what we have in terms of reported numbers, and then the reported number, this dashed line in this turquoise color, light blue color, that is then extrapolated. And this extrapolation, I explain how it works over here, gets an increasing estimation error as we get more to the most recent quarter, which is third quarter of 2025. But it gives us indicatively where current recognition comes out relative to guidance. So Tesla did increase in the last 2 quarters its next 12 months outlook. You can see this here. So this line reached a low in the first quarter of this year, then increased in the second quarter, and then increased further in the third quarter. But the recognitions tend to, by extrapolating in this way down here, imply that Tesla is already recognizing less than what they had expected. So if the past is any guide, don't shoot the messenger. I just tell you my analytical view. This would suggest that progress would be slightly below. Again, there's not a huge gap as was in the past. It's slightly below earlier expectation. But again, I have to point out the gap is not very large, unlike in the past. And number 2, this dashed line is an extrapolation. There's extrapolation error, of course. So this could be, we don't know because we don't have the data yet, could be very close to the blue line, and there was not a gap. So be very careful not to take this too far. The big picture, when I look at this chart, especially the last couple of quarters, that trend is fine. I mean, these forecasts are very, very difficult to make. So I think this is completely not bullish, not bearish. It's basically in line with expectation. So that's the end of this presentation. I hope this was helpful. So the big picture takeaways are really third quarter was much better than what the headline numbers suggested. That provides for a good sort of starting point for the fourth quarter. Fourth quarter, I think there are substantial factors that help to materially offset the weakness in the US market after end of the tax credit. And I believe by the time the weak Q4 numbers come around, which will be beginning of February, where we get first delivery numbers out of major markets and we see a first trend developing, I think people will be already so focused on Cybercap that even when numbers come in weak, which I believe is very likely because of the pullback in China, etc., they explained, that it likely has a limited effect on the stock, because by that time, if you think about it, now it's almost November, there's November, December, there's 3 months where Tesla can make more progress, can roll out ride-hailing network to more areas, etc. And we will be seeing by that time probably a lot more Cybercaps that are about to launch, and then I think will keep the sentiment strong. So thank you very much for listening. See you next one. Bye.